Imagine you own a small coffee shop. Customers buy coffee, money enters the business, ingredients and wages consume part of that money, taxes take another part, and whatever remains must support profit, debt, equipment, and future growth. Almost every financial decision connects to this simple movement of money. In this video, you will learn 80% of business finance in under 20 minutes using simple, practical examples. Follow every dollar. Imagine a landscaping company earns $10,000 this month. That $10,000 is revenue, but it is not the owner's profit. The company spends $2,000 on materials, $4,000 on employees, $1,000 on fuel and equipment, and another $1,000 on rent, insurance, software, and other operating expenses. After those costs, approximately $2,000 remains before considering taxes and certain other obligations. This simple example explains the foundation of business finance. Money enters through sales, moves through different expenses, and whatever survives becomes profit. Before making any financial decision, first understand exactly where each dollar enters and where it leaves. Separate revenue from profit. Suppose an online store sells $100,000 worth of products during the year. The owner proudly says, "My business makes $100,000, but the products cost $40,000 to purchase. Advertising costs $20,000. Shipping, software, payment processing, and other expenses consume another $25,000. The business actually keeps only $15,000 before taxes." That is why large sales numbers can create a false impression of financial success. Revenue tells you how much the business sells. Profit tells you how much economic value remains after expenses. A company can generate impressive revenue while producing very little profit for its owners. Understand your gross margin. Imagine a bakery sells a custom cake for $100. Flour, sugar, cream, decorations, packaging, and other direct ingredients cost $30. The bakery therefore has $70 remaining after the direct cost of producing that cake. That $70 is not final profit because the bakery still has rent, employee salaries, utilities, insurance, marketing, and other operating expenses. But this calculation shows how much money the product creates before those broader expenses. Now imagine ingredient costs rise to $50 while the selling price remains unchanged. The business suddenly has less money available to cover everything else. That is why owners should understand gross margin before making pricing decisions. Find your break-even point. Suppose a small gym has monthly fixed expenses of $12,000, including rent, salaries, insurance, software, and utilities. After the variable costs associated with serving each member, the gym effectively keeps about $60 from each monthly membership toward covering those fixed expenses. Divide $12,000 by $60, and the gym needs roughly 200 active memberships just to break even. At 150 members, the business is still losing money. At 200 members, it approximately covers its costs. At 300 members, the additional contribution can begin creating meaningful profit. Break-even tells owners the minimum business activity required before real profitability begins. Profit is not cash. Imagine a consulting company completes $50,000 of client work this month. On paper, the company may record $50,000 in revenue. But suppose clients have paid only $20,000 so far, while the remaining $30,000 will arrive next month. Meanwhile, payroll, rent, software, taxes, and other bills require $25,000 in actual cash this month. The income statement may suggest that the company performed well, yet the bank account can still become dangerously low. This is the difference between profit and cash flow. Profit measures financial performance over a period. Cash determines whether the business can actually pay today's bills when they become due. Control customer payment timing. Suppose a construction company completes a $40,000 project, but the customer has 60 days to pay. During those 60 days, the company still needs to pay employees, suppliers, fuel, insurance, and other expenses. Now imagine the company negotiates a 20% deposit before starting the project, another payment when major materials arrive, and the remaining balance after completion. The total project revenue may remain $40,000, but the company's cash position becomes much stronger because money arrives closer to when expenses occur. Business finance is therefore not only about how much money you earn. The timing of when money enters and leaves can determine whether growth feels comfortable or financially painful. Watch inventory trap cash. Imagine a retail business normally keeps $30,000 of inventory. The owner expects holiday sales to increase, so the company purchases another $50,000 of products. The warehouse now looks impressive, but $50,000 of cash has effectively moved from the bank account onto the shelves. If those products sell quickly, the decision may work well. If customers buy slowly, the company can become cash poor while sitting on valuable inventory. Rent, payroll, taxes, and suppliers still require money, but inventory cannot always be converted into cash immediately. This is why good inventory management is also financial management. Every unnecessary product sitting unsold represents cash the business cannot currently use elsewhere. Price for real profit. Suppose a cleaning company charges $200 for a commercial cleaning job. Labor costs $80, supplies cost $20, transportation costs $15, and payment processing plus other job-related costs add another $5. That leaves $80 before broader overhead expenses. Now suppose the owner offers a 20% discount to attract more customers. The customer pays only $160, but most operating costs remain unchanged. The company's contribution falls dramatically. To recover the lost profit, the business may need significantly more jobs. Discounts can increase sales while weakening financial performance. Before lowering prices, calculate what actually remains after delivering the product or service. No fixed and variable costs. Imagine a small manufacturing company pays $5,000 in monthly rent. Whether it produces 100 units or 1,000 units, that rent is a fixed cost. Materials, packaging, and shipping increase as production increases, making them variable costs. Suppose each product sells for $50 and its variable costs total $20. Each sale contributes $30 toward fixed expenses and eventually profit. Once enough products are sold to cover fixed costs, additional profitable sales can have a much stronger impact on earnings. Understanding this difference helps owners forecast growth. When sales increase, some expenses rise automatically, while others remain relatively stable, which changes how additional revenue converts into profit. Build a cash reserve. Suppose a restaurant normally needs $20,000 every month for payroll, rent, utilities, suppliers, insurance, and other essential expenses. Then, a major refrigerator suddenly fails and requires an $8,000 replacement while customer traffic is temporarily weak. Without cash reserves, the owner may need expensive debt or delay important payments. Now imagine the restaurant has gradually built a $60,000 reserve. The same problem is inconvenient, but it does not immediately threaten the business. A cash reserve gives owners time to respond when sales fall, equipment breaks, customers pay late, or unexpected expenses appear. Financial strength is not just producing profit. It is also surviving periods when reality does not follow the forecast. Understand working capital. Imagine a wholesale company has $80,000 in current assets, including cash, customer invoices expected soon, and inventory. It also has $50,000 in bills, supplier payments, taxes, and other short-term obligations. The difference is $30,000 of working capital. Now imagine the company grows rapidly. It purchases more inventory and gives customers longer payment terms, while suppliers still expect quick payment. Sales increase, but available cash becomes tighter. This is why growing businesses can experience financial pressure even when demand is strong. Working capital shows whether the company has enough short-term financial resources to support everyday operations without constantly searching for emergency cash. Use debt to create returns. Suppose a delivery company borrows $50,000 to purchase another vehicle. The loan costs approximately $1,000 per month, but the new vehicle allows the company to accept additional contracts, generating $3,000 in monthly profit after operating costs. That debt may create financial value because the asset produces more than its financing cost. Now imagine the same company borrows $50,000 for an expensive office renovation that produces no measurable additional revenue or savings. The monthly payment still exists, but there is no new cash flow supporting it. Debt is not automatically good or bad. The important question is whether borrowed money creates enough economic return to justify the obligation. Budget before spending money. Imagine a marketing agency expects $100,000 in revenue next quarter. Instead of treating that entire amount as available money, management creates a plan before spending it. $40,000 is allocated to payroll, $15,000 to contractors, $10,000 to marketing, $8,000 to software and office expenses, $7,000 to taxes, and $5,000 to reserves. The remaining amount provides room for profit and unexpected costs. Without this plan, several departments might spend aggressively because sales look strong. A budget gives money a purpose before it disappears. It also allows management to compare what the company planned to spend with what actually happened. Forecast: cash before trouble. Suppose a business has $70,000 in the bank today. Looking only at that number makes the company appear financially comfortable. But management creates a 12-week cash forecast and discovers something important. Payroll, inventory purchases, taxes, loan payments, and supplier bills will reduce cash to $18,000 before several large customers are expected to pay. The shortage has not happened yet, which means management still has options. The company can accelerate collections, postpone a non-essential purchase, negotiate supplier terms, or arrange financing early. A cash forecast turns future financial pressure into a visible problem. Seeing a shortage several weeks early is much better than discovering it when bills are already due. Read the income statement. Imagine a software company reports $500,000 in annual revenue. Direct service costs consume $100,000, leaving $400,000 of gross profit. Salaries, marketing, software, rent, insurance, and administrative expenses total $320,000. Approximately $80,000 remains as operating profit before certain additional items and taxes. The income statement tells the financial story of what happened over a period. Instead of simply asking whether sales increased, management can see where revenue was consumed. If revenue rises 20% while operating expenses rise 40%, growth may actually weaken profitability. Reading an income statement means following revenue downward until you understand what the business truly earns. Read the balance sheet. Suppose a manufacturing company owns $100,000 in cash, $150,000 in inventory, $200,000 in equipment, and $50,000 in customer receivables. Those resources are assets. The company also owes suppliers $70,000 and has $180,000 of loans. Those obligations are liabilities. What remains after subtracting liabilities from assets represents the owner's equity. The balance sheet is useful because profit alone cannot show the company's complete financial position. Two businesses may earn identical profits, but one might have substantial cash and little debt, while the other carries heavy obligations. The balance sheet reveals what the business owns, owes, and has built financially. Connect the cash flow statement. Imagine a company reports $100,000 in profit, but its bank balance increased by only $10,000. Where did the other money go? The cash flow statement helps explain the difference. Perhaps customers still owe $40,000. The company purchased $20,000 of inventory, bought $25,000 of equipment, and made loan principal payments. None of this automatically means the business performed badly. It simply shows that accounting, profit, and cash movement are different. The cash flow statement connects financial performance with actual money movement by showing cash generated or consumed through operations, investments, and financing. When profit looks healthy but cash looks weak, this statement helps reveal why. Measure return before investing. Suppose a warehouse is considering a new automated packing machine costing $60,000. Management estimates that the machine could reduce labor and waste by approximately $20,000 per year. Ignoring financing, taxes, maintenance, and other complications, for this simple example, the investment could recover its original cost in roughly 3 years. Now compare that with another $60,000 upgrade that saves only $5,000 annually. The second investment may look impressive but produces a much weaker financial return. Business owners constantly choose between competing uses of limited money. Before purchasing equipment, opening locations, hiring employees, or launching projects, estimate what financial benefit the investment should create and how long the capital may remain tied up. Grow without breaking cash flow. Imagine a furniture company receives enough new orders to double monthly sales. Growth sounds like excellent news, but fulfilling those orders requires $60,000 of additional wood, labor, packaging, and transportation before customers make their final payments. The company may be profitable on every order and still run short of cash while financing that growth. Management therefore negotiates customer deposits, improves supplier payment terms, increases production gradually, and keeps additional cash available. This allows expansion without putting normal operations at unnecessary risk. Growth consumes money before it creates money in many businesses. The faster a company expands, the more carefully owners should understand how much cash that growth requires and when that cash returns. Manage finance as one system. Imagine two companies each generate $1 million in annual sales. The first owner focuses almost entirely on revenue. Customers pay slowly, inventory keeps growing, margins are shrinking, debt payments are increasing, and nobody forecasts cash. The second owner tracks profit margins, customer collections, inventory, expenses, debt, working capital, cash reserves, and future cash requirements every month. Both businesses have the same revenue, but their financial strength can be completely different. This is the big lesson of business finance. Revenue, profit, cash flow, pricing, expenses, debt, assets, and growth should never be managed separately. They operate as one connected system. Understand how money moves through that system, and most financial decisions become easier to evaluate. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.